Indexed loans allow you to earn money on what the market is doing, but only be charged a nominal interest rate on the actual money you're borrowing from your policy. Now, in this episode, I'm going to answer the question, what is the difference between fixed and indexed loans? Get ready, because you're going to be blown away with what arbitrage can do for you. Hi, I'm Doug Andrew, and I've been helping people optimize their assets for 46 years. One of my favorite vehicles that I call the Dream Solution for retirement planning, for real estate management, for emergency funding, for business working capital. But most people come to me wanting to accumulate their money on a tax-favored basis and then be able to access their money tax-free down the road for whatever purposes they need. Most people came to me wanting to save for retirement. When it comes to start income coming out of their indexed universal life insurance policies, I tell them, well, and there's three ways, if you read in my book, to access money out of your insurance policy. There's the sad way, the dumb way, and there's the smart way. And they go, oh, really? Well, what's the sad way? Well, it's one heck of a return, but I don't recommend that one. That's by dying. But see, if I put in $500,000 at age 60 in a brand new index universal life policy, does this simplify this? And I died the next day, I don't leave behind $500,000 like I would in an IRA or 401k or a mutual fund. The $500,000 would blossom to $1,250,000 and transfer tax-free. The rate of return is incredible, but it's sad, okay? Now, most of my clients used universal life for living benefits. And so when they go to access money, even before retirement, but especially in retirement, there's the dumb way to pull it out and there is the smart way. So let's cover the dumb way first, and then I'll talk about the smart way by using index loans. So if I need to access money, I'm going to simplify this. And let's say at the time that I'm going to retire, I have $1 million of cash value in my index universal life policy. And you can extrapolate from this example. Now, I can take it out and withdraw my interest, okay? Because universal life is taxed FIFO. That means first in, first out. In fact, it's one of the few investments or places where you can put money that is taxed FIFO instead of LIFO. See, if I were to put $1 million, or had $1 million in an annuity, I were earning 10%, which most don't earn. If I start pulling out $100,000 a year, that's my interest. I'm pulling out my interest first, and I have to pay tax from day one. With universal life, if I start taking out $100,000 a year and I put in $1 million, then the first $100,000 is deemed part of my basis, the first money in that I invested, and that was after tax. And so it would take 10 years under that example to recover my basis. That would be tax-free. But if I kept withdrawing money starting the 11th year in this example, that would be dumb, because the IRS says, well, now you're withdrawing, you're into your gain, and you're going to have to pay tax. And the IRS actually says, don't do that. That's dumb. If you'll do it this way, just change the nomenclature. Instead of calling it a withdrawal, call it a loan. Now, critics who don't understand this, they go, what? Borrow your own money? They're going to charge you interest. Why would you borrow your own money? Oh, those people don't understand how money really works. This is why it's smart. First of all, when you borrow money for anything, you don't have to pay income tax on loan proceeds. When you borrow money for your house or your car, you don't have to pay tax on it. It's not income. So the IRS says just change what you call it, the nomenclature. Just call it a loan, and it's taxed free. You simply say, I'm going to borrow the equivalent of my interest. So let's go back to that $1 million example. If you're earning 10%, to keep it simple, and because I have averaged 10.07% for many, many years in my own universal life policies, I'm earning $100,000 a year in interest. But instead of withdrawing it, I'm saying, you know what, just leave it there. And so my million now grows to $1,100,000, and then I get compound interest on that, but it goes to $1,200,000, $1,300,000, and so forth. And so my actual cash balance is growing because I'm not withdrawing money out of it. I'm not withdrawing. I'm borrowing the equivalent of my interest. So the very first year, I have $1.1 million of cash value now, and I have $100,000 phantom loan. Now I call it phantom because the loan is never due and payable during my lifetime. I can pay it back if I want, but no, it's paid off when I die because this blossoms to the death benefit and transfers tax-free and it pays off all the loan. And so I'm simply using the loan proceeds because it's tax-free. So $1.1 million of cash value minus a $100,000 phantom loan equals the same million that I would have had I pulled it out the dumb way and paid tax on that $100,000, maybe of $30,000 or $40,000. Why do that? The next year, now my cash has grown to, let's say, $1.2 million. I have $200,000 loan balance. $1.2 million minus $200,000 is the same million that I would have had I pulled out the money the dumb way and paid a bunch of taxes. I have had people who have taken out $100,000 a year, let's say, for 20 years. They have a $2 million phantom loan balance, but they've got $4 million over here. This minus this is always the same amount or greater than if they had pulled it out the dumb way and paid a bunch of unnecessary tax. Now, there are two options when you use the loan provision when you start taking tax-free income out of an IUL policy. Let me share them with you. So the first option is the most conservative, and it's called the zero wash or zero cost loan. Some companies charge you a little tiny bit of a spread, but most of the companies where I have Universal Life, it is called a zero wash loan. So if I were to borrow my money, the insurance company is required by the IRS to charge you on your ledger a nominal interest rate to construe it as a true loan. Otherwise, it doesn't qualify. So they charge a nominal interest rate on the loan balance that's phantom, as I said. But over here on your cash that you didn't withdraw, it's growing. They credit you the same exact interest rate as they charged you on the amount of your cash value that collateralized the loan. Had you pulled it out the dumb way, in other words. So if I have $1 million and it grows to $1.1 million, $1.2 million, the 100 or 200,000 over here is being credited the same interest rate as the loan is. So many times I borrowed at 4 and they credit me 4. I borrow at 2%, they credit me 2%. It costs a net of 0, and that's what qualifies my $100,000 a year of income to be totally tax-free. It's not deemed earned, passive, or portfolio income. If you have income and it's not one of those three, it's tax-free. It's that cut and dried in the Internal Revenue Code. So when we do a fixed or zero cost loan, it is the same interest rate or almost the same interest rate, and it's called a zero wash loan. Now, what do? Most of the time, I use index loans or what are called participating loans. Now, if the economy is going down, 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 I might use a fixed loan because I can change the way I call the loan every year. Did you know that? But I use an index loan if I think the economy is going to continue to grow upward. What's that? That's where the insurance company, as your balance grows from $1 million to $1 million, $1 million, $2 million, $3 million, $5 million, $2 million, that is being credited. The entire amount is being credited with the indexed rate. Maybe you get credited 7% one year, 15% another year, 20% another year, 12% another year, maybe 0 a few years if the economy is tanking. But the average is usually between 6 to 10%. So that means I'm going to pay a higher interest for an index loan because they have to manage it a little bit differently. So a lot of the companies I use may charge you 4.5%, 4.6%, let's say 5%. So on one of mine, they charge 5% on the phantom loan balance, but they credit me whatever the index does. There have been many, many years. They have charged me 5 and they credited me 10. It wasn't a wash. They paid me twice as much. They paid me 100% more than the cost of calling it a loan. On $1 million, they charged me $50,000. If I borrowed $1 million, they charged me $50,000, but they credited me $100,000 that year, 10%. Do you know in 2017, we had many clients who borrowed, let's say $1 million out of their Universal Life policies for business or whatever. They were charged 5%, but that year, many of them got credited 16% or $160,000. So they made $160,000. Minus the 50, they netted 11% tax-free on money that was no longer in the policy that they were using for their business. And they made money there, and they kept making 11% tax-free on the balance over here because they used the smart way to pull it out. We had some in 2017 that borrowed at 5 and earned 25. So they earned $250,000 on their million that year here. They were charged $50,000. This minus this, they netted 20%. They made $200,000 tax-free on their million, even though the million wasn't really there anymore. They had borrowed it out to use it in their business. This is incredible. That's called arbitrage. This is how money really works. And so the difference between fixed and index loans is fixed is usually a wash. They charge you 2, they charge you 4, they credit you the same rate. That's a zero wash. You may want to use that when the markets are nosediving. But when the markets are growing, which is usually 70% of the time, I choose to use index or participating loans where they charge me a lower rate and I usually get credited a higher rate. If that spread is only 0.5% or 1 or 2%, it can allow you to pull out 2% more out of your nest egg on $1 million. Instead of pulling out $70,000 or $80,000 a year, I can pull out $100,000 a year and not deplete my principal because of using index loans. How incredible is that? And when people hear this, they go, say what? So if this is intriguing you and you want to learn and actually see examples of how this works, if you started tax-free income at age 65 and you live to be 120, you would see this phantom loan balance, but you'd see the cash balance, this minus this, and how you have tax-free income for life. You can see this in our most recent best-selling book, The Laser Fund. It's a 300-page book with all kinds of charts and graphs and explanations and 62 actual client stories. The book retails for $20. I would love to gift you free a copy of this book. I'll pay for the book. If you go to laserfund.com, laserfund.com, and you contribute $5.95 towards the shipping and handling, I will fire out a copy of this book for you. You can begin to learn how you can dynamically increase your rate of return by double, maybe triple over what money in the market would generate for you under the financial services industry standard 4% rule. And why the smart way to access money, in my opinion, is to use the loan provision, and probably 70% of the time, the indexed loan provision or participating loan versus the zero wash loan.